This week, we're covering the return of large-scale capital issuance. After 20 years without raising equity, Alphabet just raised $85 billion to accelerate its investment in artificial intelligence. The key metric we'll be watching is whether Alphabet and its peers can fund this opportunity without pushing their free cash flow negative. This year, Alphabet may spend close to $200 billion on investments, with some estimates suggesting that could approach $300 billion next year. On the flip side, free cash flow is expected to decline from $73 billion to just $15 billion in 2027. The central issue is whether the return on investment justifies the scale of spending. We think the answer is yes and remain constructive on the company's prospects, but investors will ultimately want to see this investment pay off with a rebound in free cash flow. Finally, the equity raise is notable because Alphabet could have leaned more heavily on debt or cash. So selling stock may tell us something about how management views its valuation, or the possibility that more debt financing could still be coming. At the same time, we may be on the verge of a new mega IPO cycle. SpaceX is reportedly targeting a $75 billion initial public offering this month at a valuation around $1.75 trillion. That would make it by far the largest IPO ever, and SpaceX may not be alone. Anthropic has confidentially filed to go public, and OpenAI is preparing for an IPO this year as well. These are extraordinary companies, but their offerings raise an important question. How much of the return has already accrued to private investors? The last question is whether investors can absorb all this new equity supply. We think the answer is yes, but it may result in some short-term volatility as investors reposition. If IPO proceeds reach a record $225 billion this year, and total equity issuance is closer to $700 billion when accounting for secondary sales, that's still only about 1% of the total US equity market. Additionally, we do expect investors to deploy at least some of the estimated $8 trillion sitting in US money market funds. On the other hand, one potential headwind is the trajectory of stock buybacks. They're still huge, with more than $1.3 trillion expected this year per Goldman Sachs, but that's roughly flat with last year. And given the changing capital intensity of tech firms, we don't expect buybacks to serve as an incremental source of stock demand in the coming years. That's a change from the 2010s. For years, the leading tech companies operated capital-light business models and deployed their free cash flow into shareholder returns. The next phase of tech is shaping up to be hardware rather than software-centric, requiring more physical investment. Investors will be tasked with funding a bigger share of the next tech cycle than they did in the last one. We think it's sustainable as long as growth remains strong. However, if growth and returns on investment disappoint, investors may become less forgiving of the capital intensity and high multiples. Please let us know if you have any questions or feedback. Thank you and have a great weekend.